Welcome back. Today we are going to solve a problem which is from bond valuation plus equity plus arbitrage from forex. Okay, three previous year questions we are going to cover in this video. So, focused area for the exams. So let's quickly solve this problem and learn this problem. Okay, bond valuation. What we have to do is, when it comes to bond, the simple concept is bond is the fixed returns, fixed return investment. No, so mostly every year the interest will be receiving the interest, and at one point will be redeeming the bond. So everything will be uh, bring it to year zero and find the value of the bond. Okay, this is the concept is in this question we are seeing the conversion, which is convertible bond. Convertible bond means at maturity we can convert to equity or we can read it as a bond. Okay, so what we have to do is just we have to check the equity value at the maturity and bond value at maturity. Whichever is higher is the best suggestion we have to give, we can give. Okay, okay, quickly solve the problem now. The question says that issued a convertible bond with a face value of 1 lakh. Okay, 1 lakh. Creates a coupon rate of 6%. I have already told that. Okay, what's the face value? Face value 1 lakh. Okay, interest rate is 6% per annum. Okay, interest rates are paid semi-annually. Semi-annually means 3% for 6 months. 6 months. 6 months. For that we have to put it for 3 years. 6 times it has to come. Okay, 1 2 3 4 5 6. Okay, now all the bond has term of 3 years, redeemed at 1,10,000. Okay, they are redeeming at 1,10,000, right? So we have to bring it to the present value of all the bond income, bond interest income, and also the redemption value. Okay, right. Now what else they have given is at the third year term we can convert the shares, can convert the bonds into 50 shares at the third year term. So we have to check whether which share or bond, whichever is giving a higher value, we have to opt that. For that they have given that share price of Paulson Limited, which is 2000. Currently the shares are expected to grow at a 8% rate, and the dividend also they have given. So PV factor they have asked us to find out the value of the bond which is redeemed at maturity, value of the share at conversion, and the value of conversion option. Okay, whichever is okay, and whichever is advantageous we have to find. Okay, let's quickly start solving the problem. The first thing, step 1 is the calculation of value of bond. Okay, year, and we have a cash flows, PV factor, cash flow of PV of cash flow. Year 1 2 3, semi-annual, no, period 1 2 3 4 5 6. So for the semi-annual period, 3% is the interest rate. What's the face value? Face value is 1 lakh. 3,000 it will come. Okay, 3%. Same for the all the years. So what we can do is instead of putting it like this, we can consolidatedly have a value, and here we can put the PVAF annuity factor for 6 years. Okay, 3000 is the interest, and PV factor at 6%, 12%, so we are calculating it for semi-annually. 6% we have to take. So everything, see, into coupon rate means 6 by 12, interest rate means 6 by 12. This is share part, so we are not touching here. Whatever the coupon rate and the required rate, no, we have to semi-annual it for the semi-annual bond. Okay, so PV factor, which is at 6%, 1 divisible by 1.06 plus 4.917. If you have added all these things, no, you can get this value. So 4.967 into 3000, which is 14,751.97 is the present value of cash flow. At the 60th year, we are redeeming the bond also. So at the 60th year, what's the PVAF, which is 0.705. So 1,10,000 into 0.705, which is 77,550. Total this will get the value of bond, which is rupees 92,301.97. Okay. Yes, next we can calculate this is the value of bond. So value of bond we have calculated. Next we can calculate the value of shares at conversion. Okay, so what's the formula? Price at the third year, right? That semi-annual part of all this drama is for only bond. When it comes to shares, only the actual year's term will be there. No semi-annual terms will be there. No semi-annual terms will be there. So P formula is D 4 divisible by KE minus G. Okay, this is the formula. We are going to use this, and we are going to find the P3 at the price of the share at maturity. Okay, now in this question they have given only the required rate of the bond. We don't know the required rate of the shares, that we have to find out. Okay, so how can we find out that? K is equal, just to reverse it. Okay, the formula is, we have a P0 value. Okay, start of the year value, we have everything. So D1 divisible by KE minus G. Just to take this here, D1 divisible by P0, K is equal to D1 by P0 plus G. What's the D1? D value is 50 shares. G is 1 plus 0.08 divisible by P0, which is growth rate is 8%, 2000 plus G. G is 0.08, right? Okay, we calculate this 50 into 1.08 divisible by 2000 plus 0.08, which is 0.107, 10.7%. Okay, so we have calculated the P. Now we are going to incorporate this and find the present value price of the share at the third year. D4 is what? For that we have to know the D values, right? So D0, D1, which is 1 plus G. D0 is 50, 1.08. This is the structure I am following, so you can also use it. Which is 54. Put it here, 54. 54 into 1.08, which is 58.32. 58.32 into 1.08, which is 62.98. 62.98 into 1.08, which is 68.02. So 68.02 divisible by KE, which is 0.107 minus G, which is 0.08 divisible by 0.27, which comes to rupees 2591. Okay, so we got the value of shares. Now the third step is multiply with 50 shares, because the at the redemption we are getting 50 shares, no? So 50, 2519 into 50, which is rupees 1,25,950 is the price of share at maturity. So now value of share is greater than value of bond. 125,950 92301.97, right? Yes. See, we have to opt for the conversion, because conversion is most beneficial. That's it. We have answered all the questions. Let's quickly solve the equity problem, the next one. Now, okay, the investor is considering to purchase equity shares of Delta Limited. Okay, Delta Limited market price is 132. Okay, let's quickly prepare the table and fill the values. Dividend, proposed dividend means D1, which is rupees 6, expected to grow. G is 20% for the next 4 years, and then okay, 19% for 50 year, 18% for 60 year, 17% is for 50 year, sorry, 7th year. So after that we have to calculate the as it will stabilize at the growth rate per annum infinitely. So okay, the growth rate after this from 8th period, it's going to stabilize. So the question is asking us to find out the stable growth rate, and the required rate of return also given, which is 20%, right? Okay, right. Okay, here dividend, which is D0, 1 plus G, which is cash flow, nothing but D1. Okay, then PV factor, present value of cash flow, here is 1 to 7, 1 2 3 4 5 6 7. D1 value they have already given, which is 6. Okay, put that 6 here. What's the G? G is first 4 years 20%, 1.2, 1.2. Post that 1% is declining for every year, 1.19, 1.18, 1.17. Okay, so let's quickly calculate 6 into 1.2, which is 7.2 into 1.2, which is 8.64 into 1.2, which is 10.37 into 1.19, 12.34 into 1.18, which is 14.56 into 1.17, which is 17.03. What's the present value factor? Present value factor is 0.8333, 0.6944, 0.5787, 0.4823, 0.4019, 0.3349, 0.2791. Okay, so multiply this 6 into 0.833, which is 5, 7.2 into 0.6944, 4.99 is coming, so 5, 8.64 into 0.5787, which is 4.99 into 5, 10.37 into 0.4823, which is this is also 5, 12.34 into 0.4019, which is 4.9596, 14.56 into 0.3349, which is 4.88, 17.03 into 0.279, which is 4.75. Total this 20 plus 4.96 plus 4.88 plus 4.75, which is 34.59. Okay, so we got the present value of dividends now, but we don't know the what's value. We don't know the growth rate. No, if we know the growth rate only, we can tell it. No, P7 is equal to DA divisible by KE minus G. We don't know the present P7 also, we don't know the G also. Okay, now how we have to calculate how we have to know the P7. So P0 is equal to, we usually do what we do, dn divisible by ke, sorry, this is not the form, this is not the infinite problem, this is just the certain problem, certain level problem. And the end of 1 minute. Okay, yes, so to calculate the P7 we'll be using this formula, but here we don't know the P7 value. No, so how we are going to find out is dn divisible by 1 plus ke plus it's no, then Pn divisible by 1 plus ke the whole power n. This is nothing but present value of dividends. This is nothing but present value of price at maturity. Okay, so present value of dividend, we know the formula, which is 34.59, but we don't know the present value of price at maturity, which is P7. Okay, but P0 we know, which is the value is 172.45. current market price they have given. So P7 plus 172.45 minus 34.59, which is 72.45 minus 34.59, which is rupees 137.86. Using this value, we are going to find out the G value, G rate. P7 is equal to D8 divisible by KE minus G. Okay, what's D1? d7 is how, d7 is what, 1 plus g divisible by ke minus g. Yeah, so p7, what's the d7 value? D7 is 17.03. One plus g ke, which is ke is nothing but k is given in the question, which is 20%, 0.2 into 0.2, which is 27.57 minus 137.86 g is equal to 17.03 plus 17.03 g. Okay, so let's take this here. 17.03, 137.86 g plus 17.03 g, 137.86 plus 17.03, which is 154.89 g, then 27.57 minus 17.03, which is 10.54 divisible by 154.89, which is 0.068 percentage. One minute, calculations are right. Okay, we missed to use the PV factor. The thing is, here it is P7, right? This is not a present value of P7. This is just the raw value. So when we get this value, we have to now multiply this with 7th year PV factor, which is 0.2791. When we do this, or we can put it as like 0.86 divisible by 0.27, which is 493.94 is equal to 17.03 plus 17.03 g divisible by 0.2 minus g, 0.2, which is 98.79 minus 493.94 g. Okay, now minus 17.03, which is 81.76 is equal to 17.03 plus 493.94, which is 510.97 g. So 81.76 divisible by 510.97, which is 16%. Yes, we got the value now. Then what asked in the question? So the thing is, we have to know, we have to be cautious with this formula. This is not this is just a P7 value, not present value of P7. Okay, now advise whether it is worth to purchase the share at this price if the investor is a stable growth rate of 15% per annum. Yes, it's more than 15%, so it's good to go, good to buy. Okay, now we have completed the equity share valuation also. Now we'll quickly jump into the arbitrage problem. Arbitrage is nothing but free money. Okay, arbitrage opportunities are exist because of the mismatch between interest rates and exchange rate between two countries. Okay, so US 4 percentage interest, India 12 percentage interest. So because of this interest mismatch, arbitrage opportunities are exist. So what we are going to do is we are going to get a loan from the low interest country. We are going to invest in high interest country. We are going to uh, uh, we are going to no, convert again to US dollars and then again pay back. The difference between is the profit. So just let's quickly solve the problem. Okay, annualized interest rate for 6 months, rupee. Okay, divisible by 2, which is 6 percentage, divisible by 2, which is, since it is 6 months, 4 percentage. Okay, right. Now let's assume, okay, $1,000 I have planned to borrow. Okay, before that I have to check whether the no, arbitrage opportunity exists or not. For that we have to use a formula, which is forward rate divisible by spot rate divisible by forward rate. Okay, forward divisible by spot rate is equal to 1 plus interest of other currency, 1 plus interest of base currency. What's the forward rate here? Forward rate is 64.920. Spot rate is 64.0123. 1 plus interest rate of other currency, which is rupee. Rupee is the other currency. Rupee is the other currency. US dollar is the base currency. Okay, interest, which is 0.06 plus 1 plus 0.04. Okay, total is 64.9120 divisible by 64.0123, which is 1.0105 or 6. Okay, 1.06 divisible by 1.04, which is 1.01923. So this is not equal, so it denotes that the arbitrage opportunity exists. Now since LHS is lesser than RHS, it denotes that base currency, other currency is giving the highest rate. This we can easily see that and find, but this is how we have to procedurally write and do. Okay, so we have to write that LHS is lesser than RHS, so opportunity exists in, so interest rate is higher in INR, Indian rupee, Indian in India. No, okay, so we have done that. Now the first process we have to do is we have to borrow $1,000 from US, $1,000 from US at the interest rate of which is for the 6 months 1.04. 1.04. How much we have to pay? 1000 into 1.04, which is $1,040 we have to pay after 6 months. Okay, now we have to we have to convert that $1,000 into INR at, what's the rate in the spot rate today? 64.0123. 1000 into 64.0123, which is 64,012.3 rupees. Okay, yes, we have converted. Now we have to invest this amount in US, in Indian banks. We have converted, we have to invest 64,000, 12.3 divisible by, what's the interest rate in sorry, into interest rate in India is 1.06 for 6 months, 1.06, which is rupees 67,853.04. Okay, now again we have to convert to US dollars. Rupees 67,853.04 divisible by, discount rate is at 6 months, which is 64.9120. How much we'll be getting? 64.9120, which is $1,045.31. Okay, what's the difference? This difference is our arbitrage gain, which is $5.31. Yes, that's it. Very simple problem. Putting a box, we can finish this problem. Okay, thank you.